Till now, we have discussed the meaning of cash flow statement. We have discussed the examples of cash inflows and cash outflows. We have discussed many transactions also, why there will be cash inflow and why there will be a cash outflow. The crux is that you have to think whether it will be affecting in any manner my cash balance or my bank balance. In both of the cases, if anyhow either cash or bank is getting affected, then it will be either inflow or cash outflow of will be there, and then you will be able to decide whether there is a cash inflow or cash outflow. Now coming to the next technical term which we have to understand, what is cash and cash equivalents? It will be also of use in this chapter. So we should understand the meaning of cash and cash equivalents. It can also be asked in the exam. What is cash inflow? What is cash outflow? What is cash and cash equivalents? So see, cash means cash in hand and cash at bank. This you have studied last year also when you were preparing the balance sheet. Now cash equivalents, the definition of cash equivalents. These are short-term, highly liquid investments that are readily convertible into known amounts of cash and which are subject to an insignificant risk of change in value. So there are a lot of features for cash equivalents. First feature is that it is always for short term. It is not for long term. Then second feature is it is highly liquid investment. Highly liquid investment means that whenever you wish to convert it into cash, you can convert it immediately at a very short notice and you will get your money back within few minutes. So that is called highly liquid investment. The moment you decide to convert it into cash, you can convert it into cash. That are readily convertible into known amounts of cash. And you should be knowing that how much cash you will be generating from there. That is also a feature of cash equivalent. So first feature was short term. Second feature is highly liquid investment. Then third feature is that it should be readily convertible into cash, known amount of cash. And then fourth feature is, and which are subject to an insignificant risk of change in value. Means, suppose I have invested for short term in a highly liquid investment, ₹100. Now, first thing that I should be knowing that I can convert it into ₹100 at any point of time whenever I wish. First thing. Then second thing is that I should be knowing how much cash I will be generating from it. So I should be knowing that at least 100 or whatever the value it is carrying on, that I will be able to generate. The value should be known. Then third is that there should be very, very, very less risk of change in value. Almost I should get at least ₹100 back. So there should not be any risk of getting the value going down. So very insignificant risk should be there. So such investment will be called cash equivalents. What are the examples of cash equivalents? So first component of your current assets is current investments. That is also cash equivalent. It is also a sort of cash equivalent. And sometimes we also term them marketable securities. Marketable securities, again, the same definition is of marketable securities. That these are highly liquid investments. We know the amount of cash in which we can convert it into, and there is a very insignificant risk of change in value. So that is termed as marketable securities or current investments. Means current investment will also be a part of cash equivalent if they are marketable securities and if they are given in the question. Then treasury bills, commercial papers, these are short-term instruments, money market instruments in which generally corporates invest or park their money which is right now idle with them, which is of not any use. Short-term deposits in bank, like you have done 3 months FD or 6 months FD, that is also known as short-term deposits. Now that 3 months FD has very insignificant risk. There is no risk associated with that. You will know that how much cash I will be getting back after 3 months or after 6 months. That you also know. And at any point of time, you can go to the bank, you can get it converted into cash immediately. You will get the cash back. Checks and drafts in hand. Obviously, whatever checks you are having or whatever drafts you are having, you can get the cash within very short period also, and there is no risk associated with them that their value can go down in any manner. So these all are the examples of cash equivalents. So in question, at one point of time, we will need to calculate cash and cash equivalents. At that time, we should be knowing what are the components of cash and cash equivalents, and we will add them all, like cash in hand, cash at bank, current investments, treasury bills, commercial paper, short-term investments, checks and drafts. These all will be added. Normally, the maximum maturity period of 90 days, 3 months from the date of its acquisition, is considered for a short-term investment to be classified as cash equivalents. Unless specified otherwise, current investments are considered as marketable securities and included in cash and cash equivalents. So whenever you will be getting this term in the question, current investments, there are two things which you should do. First, you always include current investments in your cash and cash equivalents. And you can also mention in the working notes that I have assumed that current investments as marketable securities. That's why I have included current investments in the cash and cash equivalents. Sometimes it will be specifically mentioned in the question that current investments are marketable securities. Sometimes it is not clearly mentioned. In that case, we can also assume it. Now, objectives of cash flow statements. What are the objectives of cash flow statements? To provide information about cash inflows and outflows from various activities. See, one principle you have discussed last year, full disclosure, principle of full disclosure. So you have to disclose each and every crucial information, material information to the stakeholders. So according to that principle, whatever cash inflows or outflows are there, with the segregation into these 3 different activities, you have to also disclose. So that's why the first objective of cash flow statement is that you have to inform, you want to inform your investors, your creditors, your suppliers, and many other stakeholders that what type of cash we are generating from which activity, to determine the net change in the cash and cash equivalents and what changes has been there in the cash and cash equivalents since the last closing date, that is last year 31st March till today. What are the changes in there and why these changes are there? So you are explaining each and everything regarding cash. Cash is a very important component for any big organization, and use of that cash effectively and efficiently matters a lot in such case, because companies are having huge amount of cash. So we have to disclose that this cash which you have given to us for some business purposes, we are not misusing that cash in any manner. That will give this result. How it will be, when we will be discussing these all 3 activities, at that time you will be able to understand these things. Okay, now coming to the next part, importance, uses of cash flow statement, limitations of cash flow statement. That is little bit theoretical part, and I will request please go through your books, just read out them. What are the importance or uses of cash flow statement, or what are the limitations of cash flow statement? And if you feel explanation for any point is required, you can ask me, you can inform me, I will explain it. But it is little bit theoretical part, that's why I am leaving that, but you should be knowing that. Then next is transactions which could not result in outflow and inflow. Now, in the morning we have discussed there are few transactions which are either inflow or outflow. So, but there can be some transactions which will not affect cash or bank in any manner. So now you can see cash withdrawn from bank for business. Now, if I convert into a journal entry, I want to make a journal entry, cash withdrawn from bank for business. This is a transaction which you have studied last year also. The journal entry will be what? Journal entry will be cash account debit to bank account. So what is practically happening? Cash is increasing and bank is decreasing. So because both are the components of cash and cash equivalents, so this part is increasing and this part is decreasing, even then your cash will remain same. So there will be no change. So that will not result in inflow or outflow of cash. Sometimes examiner also asks a question that state whether this will be an inflow or outflow of cash, and in that question you may get this transaction. So you have to explain what is happening, and that's why there will be no change in the cash and cash equivalents. Second is cash deposit into bank. Now the journal entry will be bank account debit to cash account. Now what is happening? Bank balance is increasing and cash balance is decreasing. But even then your cash will remain same because both are the components of cash and cash equivalents. So that's why this will not result in inflow or outflow of cash. Then third one is sale purchase of short-term marketable securities. So if I am selling short-term marketable securities, suppose I am selling the short-term marketable securities, what is happening? This component cash equivalents will get reduced and I will be receiving cash, this component will increase. So because these all are components of cash and cash equivalents, so there one component is decreasing and one component is increasing. Ultimately, the balance of cash and cash equivalents will remain unchanged. That's why due to these transactions, there will be neither outflow nor inflow of cash. That's why it is termed as these are transactions which will not result in outflow and inflow. So you should be knowing these transactions also. Now coming to the very important part of this chapter, classification of activities for the preparation of cash flow statement. So first thing which you should be knowing that cash flow statement is prepared because of as per the accounting standard 3. Cash flow statement is prepared according to the accounting standard 3, revised. Revised is also a very keyword for this because earlier in AS3 there were some points which were missing that have been included in, that's why it is termed as AS3 revised. So if sometimes examiner asks you that as per which accounting standard we are preparing cash flow statement, so at that time you should mention clearly that we are preparing cash flow statement as per accounting standard 3 revised. You should be stating revised word also. And the classification of activities is done into 3 aspects. One is termed as operating activity, one is termed as investing activity, and one is termed as financing activity. So we will discuss these 3 terms tomorrow. Tomorrow I will not go to that technical part because a lot of students are not there in the class today.